Hello everyone, welcome to Building Accountants. Today we'll be discussing the basics of accounting. Surely you've asked yourself this question before. What is accounting? Accounting is a continuous process that involves bookkeeping of transactions, reporting of financial activities through financial statements to the users thereof. What do you want to achieve in accounting? We want to provide financial information about the economic activities of the entity to current and future parties like current and potential investors, suppliers, government employees, to enable them to make informed decisions about the entity. Accounting is two domains, namely financial accounting and management accounting. We'll first have a look at management accounting. What is management accounting? Management accounting reports on specific activities inside the entity and mainly caters for internal users of financial information. This is mainly compiled weekly, monthly, quarterly, and on half-yearly basis. You'll be analyzing information to provide explanation internally and externally. Management accounting comprises of budgeting, performance analysis, cost accounting, cause and effect, decision making, problem solving, planning, forecasting. What do financial accountants do? Financial accountants supply financial information to answer internal and external questions and make decisions. Owners will ask, did we make subsidiary profits this year? Managers will ask, can we pay dividends? Can we give raises? Employees will ask, did the company pay into the pension fund this year? Government agencies will ask, did the company report the correct information to investors? Investors and creditors will ask, did the company generate satisfactory revenue this year? Now that we know what financial accountants do, let's have a look at what is financial accounting. Financial accounting mainly caters for external users of financial information, which is communicated using three primary statements, namely statement of cash flow, statement of profit and loss and other comprehensive income, and statement of financial position. Statement of cash flows is a financial statement that summarizes the amount of cash and cash equivalents entering and leaving the entity. It measures how well an entity manages its cash position, how well the entity generates cash to pay its debt obligations and fund its operating expenses. Statement of profit and loss and other comprehensive income. The purpose of the statement is to show an entity's financial performance in a way that is useful to a wide range of users so they may be able to attempt to assess the future net cash inflows of the entity. Profit or loss include all items of income like rental income, commission income, sales, etc., and expenses like water and electricity, advertising, cost of sales, etc., except those items recognized in the OCI. Then we have the statement of financial position, also known as the balance sheet. Represents the asset, what the business owns and controls, delivery vehicle, bank, inventory, liabilities, what it owes, bank overdraft, loans, and equity, the investment that the owner has contributed, capital, retained earnings, etc., at a particular point in time, normally at year end. All of this leads us to a very important aspect of accounting, which is the accounting equation, where assets equals to liabilities plus equity. Then we had the double entry system introduced, where all transactions and the amounts entered as debits must be equal to the amounts of the credits. For every business transaction, amounts must be recorded in a minimum of two accounts. Then we have a mnemonic dead click. Debit, expenses, assets, drawings, dividends. Credit, liabilities, income, capital. What does this mean? So, all your expenses, asset, drawings, dividends increase on the debit side and they decrease on the credit side. And then your liabilities, income, capital, they increase on the credit side and they decrease on the debit side. Then we have an example where we record the transaction in the general journal. The entity buys trading stock of 2,000 for cash. So what you need to do is ask yourself, what will the accounts be involved? Is the account increasing or decreasing? And then you can record in your general journal. So what's affected here is trading stock and bank. Trading stock and bank are asset because it is what we own and control as a business. We have more trading stock and we have less of bank. That means trading stock is going to increase, and trading stock as an asset increases on the debit side, while bank will be on the credit side because it's decreasing on the credit side. I hope that really helped with understanding the basics of accounting. That's it for today. Thank you.